anything exciting happening in Moorhead this weekend?
Heck no.
No? Hey, you got the regional tournament here.
There's a car show in Huntington today.
Huh?
There's a car show in Huntington today. Not in Moorhead, but
Why they have a car show on today? Why not do it tomorrow?
I think it's probably like a weekend thing.
Oh, okay. Yeah, I don't care too much for car shows. I can't afford them anyway.
It's like window shopping.
Huh?
It's almost like window shopping.
Yeah, I know, and I think
I
that's,
don't like.
my wife can do that. She can shop with the best of them. I mean, jeez. And she enjoys it even if she don't buy nothing, which to me is totally stupid.
That's torture though.
I just, if I'm going shopping, I want to know what I need, go get it. If it's a price I like, buy it and get on.
That's how all men shop.
Yeah.
Oh, there's a few exceptions. but-
Well, that's because we're logical.
Gotta look back.
Come on, give me a response there, Alexis. I know you're thinking something. You're wanting to say something. Go ahead. Go ahead and say it. I mean, it only costs you 20 points on this. Don't go ahead and say it. Just kidding. No, it's I've learned that if I have to go with her shopping, I stick a book in her car. If a person was smart, you rent space in a mall, put lazy boy chairs out with TVs,
12 hours.
and charge so much per hour. You can make money. Because I guarantee if you walk around the mall, you look at where they got the benches and stuff, do a survey. What percentage is female and what percentage is male sitting there? I guarantee you male will be predominant. And generally sitting there with packages or a purse too, sitting there waiting for their significant other. Yeah. Okay, let's see who's here today. Time to start. Where's Steven? He sick or something? Yeah, here, Lauren, Erica, Brandon, Mason, Travis, Leslie, and okay, before we get back to EVA, finish up, I do want to let's look at some information, look at a problem. I know several questions on the online class, and I have a feeling they were having problems with one homework problem, and I have a feeling that if they are, then a lot of y'all in here might be when you get on. Have we looked at them? They're going, what the heck, quiz is due today, homework's due on the 4th, why would I look at it today? Yeah, why?
See, we're logical.
Huh?
See, we're logical.
That's not called logic.
Sure is.
But then again, you were never a Boy Scout, right?
I can honestly say I was not.
Yeah, but if you were a Boy Scout, what's the motto of the Boy Scouts?
Be prepared.
Be prepared. That's right, be prepared.
Let's wait to the point.
Logical. I wish I had this article. I lost it. I would love to have it back. Somebody wrote, it was a newspaper article. It was comparing the differences between men and women and of how they think. And I mean, it was, because I read it to my wife and read it to several females, and they all said, yeah, that's right. That's exactly right. And I mean, it was to a T about how you women, time does not mean what it does to a man. And you think about things, and my wife does this all the time, bring up something that's like happened 15 years ago, and like I'm supposed to remember it like that. Plus, also the fact that we were never even talking about this yet, that I should be on her wavelength automatically. And like, what the heck are you talking about? Well, I told you. Remember when you did this? No, I don't really know what I had for lunch yesterday. How do I know what it was? But I do remember one part of it says, if it's an all-male construction crew, that you would be told, the foreman would come out and say, put beam A here, beam B here, beam C here, put crossbar D and E here and here. If it's all female crew, they walk out and say, put that over there, that there, and that there, and put that there and there. And all the females would understand it. The males would be going, huh, what? And but there was a lot of truth there and things about like restaurants and how you pick them and all that. Like I say, I wish I could have it because it was so funny. And like I say, that people admitted when I read to them, they go, yeah, that's, especially married couple are going, yep, that's pretty much how it works. Okay, one of the problems that everybody's getting fluffed up on, it's got several people, and I had a couple of emails even, is the problem 3 on your assignments. And what it is how we measure things. And the thing about it is, in all of what we're doing here with ROI, with residual income, with the EVA, and we'll come back to it too, depends on how do we value these things? Do we use gross book? Do we use historic cost, current cost? Should we do it at the beginning of the period or the end of the period? And you say, what big deal? Well, think about it. If we value things from the beginning of the period, well, that management may be more apt to buy stuff toward the end of the year, right? Because then those assets are acquiring air may help pump up income, but they're not going to be charged against the base, the denominator. On the other hand, if we use end of the year, they might not want to buy anything till first of next year, right? So again, what I'm trying to get to and explain to is you got to be careful and understand what the rules are and how we're calculating these things. And you want to be careful that you don't get in a system where the tail is wagging the dog. We're not doing something because, well, this won't calculate out right. And I mean, it happens all the time. People do that, but we need to be aware of that and understand that. We sometimes make decisions there. Now, visual assets and how should we measure them? Well, again, just going through his, I think we looked at this earlier, but just a little bit of a review. When we do gross book versus net book, notice how gross book you just use your investment of 500. On net book, you are deducting the denominators being reduced by accumulated depreciation. Again, the asset is being depreciated 50 a year. Notice we do reduce the numerator by the 50 by depreciation expense on both gross and net. The difference is the denominator, where over here we just use the 500,000 original. Over here we're using the cost book value, net book value, cost minus accumulated depreciation. That's what it's doing. Now again, historic cost, current cost, what would it take to replace or rebuild that existing asset? And original cost is historic cost to build or purchase. Well, I love these graphics. Okay. Now, operating profits before depreciation, 100, 120, 144. Annual rate of price changes is 20%. Cost to begin year one is 500. Straight line depreciation is used, it's 10%. Amounts are in thousands of dollars. Now again, notice what we're doing here. We're converting on historic cost. It's again basically what we're saying, the 50 depreciation expense each time. Again, notice we take out depreciation expense each year, but it stays constant at 50. The accumulated depreciation is what we subtract off the denominator. Notice revenue's going up. Now, over on current cost, notice what we're doing is we're changing the value of the asset to the current cost. What if we did it this year? And we use 10% as our depreciation figure. So you say, where'd they get 600? 500 times 1.2 gives you 600. 600 times 1.2 is 720. 720 times 1.2 is 864. And you say, why are they multiplied by 0.1, 0.2, 0.3 on the denominator? Well, that's because that's accumulated depreciation. So the first year you got 10% of it, depreciation expense. The second year you would have 10% plus 10% is 20%. Third year, and another 10% to it, you get 30%. That's the 0.3. But again, that in doing the net book, gross book, as you can see there. But I mean, are we okay with what they're doing there? What we're showing? For practice then, and again, like I say, and as I said there, do you use beginning of the year, end of the year, or some kind of average? And again, what you're doing when it doesn't take long for somebody to look at it and say, okay, how do I manipulate this to my benefit? And we do the timing of purchases of assets and disposition of assets. Again, if I'm based on the end of the year, I might like to dispose of some assets right before the end of the year. Use them during the year, dispose of them, makes my denominator smaller, calculates better, higher percentage, right, on these calculations. On the other hand, I may not want to increase my assets at the end of the year. Let's wait till the first of the year, I put them off. And does management do that? Absolutely. Why do you think, and again, I'm assuming y'all haven't worked in companies, factories, things like this situation. A lot of times they will put off repairs. Why? Because that cuts down into operating time, hence how we're being evaluated, where we're using residual, ROI, EVA, whatever. But then if you have a new set of management come in, I guarantee you I don't care when they come in during the year, new manager comes in, what are they going to do? We're going to repair everything we can. Why? What's the logic for that? And there is a logic.
So that way the next year they look really good.
Okay, what happens at the end of year one? And we've repaired everything, we've had downtime and all that, we've had expenditures, repairing stuff and all that. However we're being evaluated, what's it gonna look like? Good, bad?
It'll look like.
Will it be up or down, you
It'll be
think?
down, because they spent all the money, and then the next year, they're probably gonna be operating more
Okay,
efficiently,
it's
so
gonna
it'll
be-
look like it. They
Exactly, it's gonna be down. What are they gonna say?
It was whoever's fault.
Yeah.
Yeah, whoever was ahead of me, man, I tell you, we're struggling, but we're gonna get turned around next year. We're gonna get it done. You don't say, no, we just repaired everything that needed to be repaired for the last 5 years and hadn't been touched. Which can be. But they do that. Why? Because in year two, then your repairs, maintenance expense should be lower since you have fixed everything, right? Now, not that you eliminate things, tear up, break all the time. But typically, major repairs, all that should be, if you take care of them, should last a little bit, right? And so, what happens to those averages? However you're being evaluated. And what do? You puff out and say, look how I turned things around from last year. And people look at it and fall for it. That's why I say, that's why you got to be careful what rules we're using and learning how to evaluate it. Because perceptions, I'm sorry, I don't care your political leanings and all that, but when the president gets out there and blames everybody, blames Congress for what happens today with that, all you got to do is go back and read. Whose idea was it to come up with this plan? It was the president's. It's like, good, bad, whatever, dude. You're the one that signed it in and said, let's do it this way. Perceptions. See, there's a lot of people like University of Tennessee. I can't understand it. Perceptions. My feeling is they pick the color of orange because it works for them. Monday through Friday, they can pick the trash up along the road. Saturdays, they can go home, go to the games. Sundays, they can go home. Never had to change clothes. Any Tennessee fans out there? Okay. Yeah, I've always told my greatest fear was I'd raise a son that was one of the best football players ever, and they would sign with the University of Tennessee. Then I'd say, you know, it'd be bad because the kid could never come home for Thanksgiving. Because you would have played Kentucky the week before, like, sorry, son, you ain't coming home. Okay. Let's look at problem 32 that's similar, a little bit similar to what they're doing on the homework. Let's make sure we know how to do it. Okay? Then we'll go back to it and make sure we understand it. Okay. I used to have a run that lady, she's passed away now, but she was a big Tennessee fan I taught with. And every year when Tennessee generally beat Kentucky in football, I'd always get a carton. This is how long ago, so you still had cartons of pop. Y'all probably don't even know what they are. But I'd get a carton of orange pop. Now, when Kentucky would beat them in basketball or something, I would get her a blueberry pie and give it to her. So we had a running tradition like that. It was fun. Okay, looking at 32 here. We got the upper division of the lower company acquired an asset with a cost of $600, a 4-year life. Cash flows from the asset considering the effects of inflation are scheduled as follows. They were nice. They didn't say you had to calculate it. I think on the problem you may have to calculate, right? But it's real hard. Just crunch it out. The cost of the asset is expected to increase at a rate of 10% per year, compounded each year. Performance measures are based on beginning year gross book values for the investment base. It says, what is the ROI for each year of the asset's life using a historical cost approach? Well, okay, let's do historical cost. First year cash flows are $225, and we paid $600. So do we take historical cost? We got what, year one? That show up? This blue? Okay. And year 4. So do we just take 225 divided by 600 to get ROI here? Is that what we did?
No, the depreciation,
Okay, so how much would depreciation be in year 1?
150,000.
Minus 150,000. So we got really 75 divided by 600. So what is ROI here? Yeah, get your calculator now. $12.5. Okay. So what's the calculation we need to make in year 2? Can somebody give me the numerator and denominator?
$255 minus the 150.
Yeah, 255 minus the 150,
Oh,
600. Okay.
minus
Minus
the 150.
the 150?
Yeah.
Okay. Why just 150? Why don't we double that to 300 in year 2? Anybody tell me? Because I think the problem you may do that. Why do we not? Why would you subtract out the 150? Or do we? They didn't say, did they? I don't read that. Does it say gross or net?
Gross.
Gross?
Beginning of the year gross book value.
Ah, so we don't subtract out the 150. So what do we get?
$17.5.
17.5. Now, by the way, what Tom was doing would have been net method. And if the net method was being used, we would subtract 150. But why would we not subtract it up here and we subtract the 150 here? What would I have to change to say, we're going to do the net method, and I subtract 150 here and I subtract 300 here on year 2? What would I change in the problem? Once, instead of saying gross, I change it to net. What would I change?
The denominator.
No.
And
End of the year. It said, you said it. You said it's gross beginning of the year. Well, if I say net end of the year, then I got to subtract out 150 here, because at the end of the year I do have 150,000 accumulated depreciation. I have 300 at the end of year 2, right? But if I say beginning of the year net, I subtract 0 here, but 150 here. Again, what's the value of it at the beginning of, or the end of the year? So it does matter what they tell you. Are they telling you to do it beginning of the year or end of the year? Does that make sense? So you do have to be careful and read what are they telling you. Now, in year 3, what was it? 285. So again, just real simple. 285 minus the 150 again, divided by 600. What we get?
22.5.
22.5. Thank you. And what was the 4th year was 300. So in essence, 25%, I assume. Is that correct?
yeah,
Okay. Okay, notice again, this is gross beginning of the year. Historic cost. Now again, if we just said net, we do reduce the denominator too. Again, what is the value of the assets at the beginning of the year or end of the year, depending on what we suggest, right?
Why did you say that sometimes you would like double it to make it for you? Like, how do you know not to do that? Is it just?
Okay, if we're doing net, now again, this is historic gross beginning of year. Okay? Well, let's just change it. Let's do historic cost again. But let's do net end of year. Okay? So now what do I have? Year 1, I got 225 minus 150, right? And then I'd have 600 minus 150. Would I not?
Yeah.
Because the value of that would be that. Now, in other words, in year 2, what's happening is your numerators are really not changing, are you? It's the denominator that's changing. Or you could add 2 together and say it's 300,000, right? Depreciation year 1 and 2. And here it's going to be what? 285 minus 150 and 600 minus 450, right? Can't calculate it for year 4, can we? Can't calculate it for why? Because you'd be, divided by 0. But that's why you generally don't see it that way. Okay. Now, the other part of it is on 2, it says, what is ROI if we use current cost? of the asset at the start of each year. Okay? And they tell us that we have an increase of 10%, right? So here, current cost, year one, we've got what, 225 minus 25% of 600,000, isn't it? Divided by 600,000, right? This current cost. And so ROI is going to be what? 12.5. It's not going to change in year one. Again. Go. Try this one. Now, in our cash flows have already been adjusted, right? For us, so we don't have to fool with that. If they didn't, we would have to adjust it. But in year two, we got what, 255? What's the value of the asset base?
660,000.
660,000. You say, how are you getting that? 600,000 times 10%. 660, right? Now, from this, what's our ROI now? So you take 25. Why am I taking 25% in the numerator there? Yeah, it's a 4-year asset, right? So straight line would be 25% a year. So what's my ROI here?
13.64.
Okay, year three. I got what, 285 minus 0.25, but let's find out. What's 660 times 1.1? 726? And what do we come up with?
$14.26.
14.26. And year four, we got what, 300? And what's 726 times 1.1?
$799.
799,000 even?
Well, 798.6.
798, 600?
Yeah.
So what's ROI there? 12.57? Okay. Now again, net method, we do reduce the denominator as well. Gross, we don't. Okay? Everybody fine there? Okay. Let's go back and look at EVA, what we were talking about the other day. Again, that might help you with problem 3 a little bit, just how you adjust it. Just remember, take out depreciation expense and if you use a net book, remember accumulated depreciation is deducted out on the denominator. So, by the way, it's your problem 3 is problem 31. So just different numbers. And so you're doing current cost and historic cost, net and gross. Okay. How do we calculate EVA? Anybody remember? What is EVA? Any clues?
Economic value added.
Economic value added. Okay. So basically what we take is after-tax income plus or minus any adjustments, minus the divisional assets plus or minus any adjustments. And, basically what we're saying is that the computation of the EVA would be exactly what would be made if the accountant mistakenly recorded the entire cost of machine as an expense instead of recorded as an asset depreciated over useful life. Or if we take R&D and treat, okay, let's amortize it over its useful life instead of expensing it immediately. Conceptually, this EVA does address problems that's associated with ROI and residual income. Supposedly takes care of it. It's not a ratio, so managers are willing to invest in projects as long as the EVA is positive, like residual income. And it does correct many of the accounting distortions that make other measures myopic. But the difficulty with the EVA is that you're simply replacing one accounting system with another. And it may be problematic to implement it. People may not understand it. Again, it does not resolve the suboptimization problem. The thing about it is the basic problem we have with the suboptimization is that EVA and the others are based on accounting income and accounting income is what's happened. It's historic. Whereas the decision is to invest is based on the present value and future value of cash flows. And not everything that happens in the past will happen again exactly like that. Things do change. And that is a problem. And there is, in research, there's very little evidence, guys, that using EVA for the unit decisions, that it helps managers make better decisions or is a decided advantage in decision making. Not much evidence. Now, going back and looking at how do we calculate, let's look at a couple of problems if we have time, and I think we'll do. And again, got to make up so much, it's just easier to use these numbers here. First of all, let's look at 40. We'll look at 40 and 41. Take a second and read 40. Okay, what's the first thing we need to do in this problem? And we're doing ROI and EVA, but let's. What's the two alternatives here we're talking about?
Whether or not to carry the sharps appliances and then to make a floor plan for them.
Okay. First of all, they want us to calculate the expected ROI if if they do not carry Sharps appliances. And it says, what is the store's expected ROI if they do carry the Sharps inventory and carry the appliance line? So basically, we got, either regular merchandise. Easiest way to do it is do regular merchandise, do the appliances, and then do a total column, right? That'll answer A and B all in one. But to calculate ROI, what do we need? How do we calculate ROI? What do we need? Anybody remember? Operating income and over assets, investment, right? Well, we got to come up with operating income, right? So how we do that? Okay, we got revenue, sales, minus what?
Cost of goods sold.
Cost of goods sold. And we got just the regular. We got appliances. And we got a total here. Add the two together, right? Total column. What's revenue from regular? To tell us?
2,340,000.
Okay. 2,340,000. What is from appliances?
$675,000.
Yeah, 675,000. And if we do it together, it's going to be a little over 3 million, isn't it? 3,015,000. Is that correct?
Yes.
Okay. What's cost of goods sold under regular?
1,467,000.
1,467,000. And appliances.
513,000.
And if we add that together, it'd be 1,009,000.
1,980,000.
80, okay. And if we subtract that, we get what, gross profit? And so we can do that. $873,000?
Yes.
Okay, and over here we got what, 162? And those two add together, hopefully would be 2,573, carry the 1 million?
Yes.
35,000? Okay, what do we subtract out from gross profit? Operating expense. And so we get, what do they give us for operating expense? 234? Okay. $234. What is it for the appliance?
76,
176?
just 76.
Oh, 76. And if we add those two together, it'd be what, 310?
76.5.
Oh, 76.5, excuse me. And so what, 310.5? Okay. And if we subtract the operating expense, what we get? Operating profit? What is operating profit?
639.
639? Excuse me. Something 500. 85? And the two add together?
724.
724. Okay, now we got our operating profit. And you said, what else do we need? Okay, the investment, right? And so the investment base with regular is what?
1,687,500.
1,687,500. What is it for the appliances? 495,000. And the two added together, 2 million what? Something 500.
182.
Okay. Now tell me, calculate ROI for the three there.
$37.87 for the record.
Okay, ROI, 37.87%. What is it for appliances?
17.27.
And for total?
35.2.
Everybody okay with that?
33.
33.2? Okay. Everybody okay with that? Now, what is their cost of capital?
10%.
10%. So, what do you think they're going to do? You think they're going to carry the appliances? Based on this?
They should, they can, but they're probably.
Okay, again, if you're measured on ROI, your manager is not going to be too apt for this because you're going from 37.87 down to 33.2. Even though the appliances is over 7% more than what their cost of capital. Yes. Now, if the floor plan is used, now what is the floor plan? Somebody explain that? What changes here in our calculations? In calculating ROI.
It's going to lower your investment. It'll be like, as opposed to when you with the appliances regularly.
Okay, so our base is going to go back to $1,687,500, right? Yeah. So do we use 724.5? Divide by that?
No.
What we got to do with the 724.5?
Minus the cost,
Huh? Minus what?
6750.
Minus 60,750. What we have to pay them, right? Now what's ROI?
39.3%.
So if we use the floor plan, our investment may stay the same, but actually we do increase our operating income. What do you think management's going to feel about this? And it says, which would you prefer as a manager, A, B, or C? C. Obviously, largest ROI, right? Now, let's see, would any of our answers change if we use EVA to evaluate performance? What changes now if we go to EVA? Well, let's just go look at our table up there. Let's go down the regular column first. Does revenue change? Does cost of sales change? No. So gross profit's still $873,000, right? Okay. Operating expenses still be $234,000? Okay, that gives us operating profit of $639,000. What else do we have to do here? We don't do something, it's going to be the same, isn't it?
Would it be the assets, change the divisional assets?
Well, you have to account for the cost of capital, remember? What is the cost of capital?
10%.
10%, right? So, we got another line up here. Minus cost of capital. Well, what would be cost of capital under regular?
10%.
$63,900.
What did we say the cost of capital was? What was our investment under regular? What was our investment under the regular? 1,687,500, right? So what's 10% of that?
168,750.
168,750. So 470,250. What do we call that 470,250? EVA. That is your EVA. What is it? What would be the cost of capital here? $29,500. Huh?
49.
Thank you, man. 49,000.
No, no,
No, no.
49,500 is the cost.
Oh, sorry, 49. So what's this? Be what, 36.5? Is that wrong? You shake your head.
Let's say 85,500 or 500 or 49,500.
Ah, you're right, could be, yeah.
There we go.
Okay, now, we're good now. What's the cost of capital in this one? Something 250, I would assume. And 217, 250, is that correct? And what? This would be 250 and hopefully 506, 250. If I did math right, but doing my head, who knows? So, again, of these three, if we're just using EVA to evaluate, manager's going to be okay with doing the appliances, right? What about the floor plan? How does that change things?
It's going to lower your operating profit.
Hmm?
Well, it's the same as we did last one, right? It just lower your top number, but your bottom number's going to be the same.
Well, we got the 724,500, right? We got a floor change of 60,750, which gives us a net profit of what? I mean, we got that over there under the floor plan. 724,500 minus the 60,750. What's that give us? A net profit of what? I don't know. You got to calculate. What is it?
663,750.
663,750. Again, I'm just doing this. But we still have to take out our cost of capital, which we said was what, 168,750?
495.
195? So, would the manager be in favor of the floor plan under EVA?
Comparing it to everything,
Yeah. Why?
it's going to be a lower EVA than.
Exactly. Notice, under EVA, we just be willing to sell appliances, right? Because that's 506, 250 as opposed to 495 with a floor plan. So if we're using EVA to evaluate, we'd say no to the floor plan. If we're using ROI, we'd say yes. Notice how it's clear as mud now, how to use these things. That happens. You will get different results out of the same things. Same thing. Okay? Does this help any at all, or just confusing you more?
Clear the mud up.
Clear the mud up a little bit? Again, you say, well, what does management do? Well, again, when you get different results for different things, it really comes down to which one do they feel gives the most emphasis, gives the better result. And again, when you're starting to use things like this, you come up with different results, and it comes down to just almost like, well, what does management prefer? You know, and you can justify any way you want. Again, as Mark Twain said, there's 3 types of lies: white lies, expletive lies, and statistics. And so if you want to prove your point, what do? If I'm wanting to do the floor plan, I'm probably going to present ROI. If I don't want to do the floor plan, but I want to carry the appliances, I'm probably going to do EVA. Now, those making the decisions need to do what? Look at both and see what's the better benefit for the company as a whole. And you say, well, what happens? What happens when we do get mixed results like this? What do we do? Do we flip a coin or what? What do you think management does? No idea? Well, you start going to, if we look at numbers like this and we're getting mixed results, we start looking at other factors, qualitative factors. One qualitative factor on this, well, it's really not a qualitative factor. One that I would look at, what's my cash flows? You know, if I'm going to carry that line, do I have to pay up front? Or can I just pay that $60,000 doing the floor plan? Which one's easier on cash flows? The timing of it. You know, I start looking at issues like that and say, okay, which way does that tip the scales? And that's the kind of thing you start looking at. You know, what are the other factors added up onto this? Which one is most beneficial to us in our situation? Because you don't want to get to the point where we're cutting our own throats. Now, do companies do that? Absolutely, they do. Not because people generally don't do it if they know what they're doing. Problem is, we sometimes do things and we don't know what the consequences are. We have these unexpected results. Okay. I just got a couple of minutes here. We'll hold off. We'll look at 41, finish this chapter up, probably start the next chapter, but the exam will be Wednesday. Format will be similar to what you had the first test.